Good morning. Still Tuesday the 29th. The markets have been open for about an hour so far. This week we've been making a comparison between a long put and a calendar spread. Yesterday we placed the two orders. We were working with Salesforce CRM. Our long put, which was at a strike price of 267.5, filled at 223. That's our max loss, and I put in parentheses here if we're asleep at the wheel, because we should never let it go to a max loss. Unless there's a buyout on this stock and it shoots up to 1,000 points and the put goes to zero overnight, unless it's something ridiculous like that, we should not let ourselves get to a full max loss on this. Now, in theory, the stock could go to zero. That's not very likely to happen either. But my point being, our reward to risk ratio here can be phenomenal, right? If we've accurately called a falling stock, which this is not, it was barely more likely to go down than up. But if your forecasting skills are that good, that's when you'd consider being an individual call, individual put trader. I'm usually not that good. Calendar spreads. It filled at 98 cents. Notice that we have less than half as our max loss. Again, we'd only get that max loss if we're asleep at the wheel. There are two commissions, and closing out, you're going to have two commissions as well. So always bear that in mind. Don't let the commission sneak up on you. And our max profit is quite limited. Now, to get the max profit, we would have to close exactly at 260, our strike prices, and it would have to be on expiration day. We would never wait that long for it to happen. Formulate in your mind how much of an increase or possibly decrease you would accept if the trade goes in your favor or against you. I commonly like to take 10%, though I would probably push that longer in this circumstance, so I could go over more things. Okay? All right, let's take a look next at the chart. Here's what the two trades together look like. Let's take it down to just the calendar spread. Okay? Notice that the apex, the peak of our calendar spread, is the strike prices that we have chosen, 260. Notice also that we are slightly up. Look at that turquoise line. We're ever so slightly up right now. We're up about $8 right now. That's not enough. But if we were up, say, 15 to 20, and this was a real trade, I'd strongly consider closing it. In fact, I probably would. Okay? But this is for illustrative purposes, and so I'm going to hang on a little longer and illustrate. Notice that as of right now, we are in a slight time decay situation, even on our calendar spread. If this stock does not move and just stays right here over the next 2 days, notice that number right there, okay? But if it stays right here all the way to expiration, we'd barely break even. We'd be about $2 up, whereas we're up $9 now, so that's a negative time decay. Our long put right now is slightly down. You can see that we're down about $21. We do have a negative time decay. So we need this stock to behave itself, do our forecast, and go lower for us to really make money here. Let's break here for today, and let's look at it again tomorrow. Good luck out there with all of your trades. Bye for now.